All right. Good afternoon, everyone. Welcome to this evolution of liquid funds and VCs. Today, we have a very exciting expert panels. I'm Laura from MNNC Group. On my left, we have Paola Origel from Hyla Fund Management. Hyla is a multi-manager, multi-platform that they've been around since 2017. Next to Paola, we have Jack Platts from Hypersphere, co-founder and a managing partner. And then at the end, we have Kelvin from Spartan Group, another leading investment firm in crypto. So with no further delay, let's get started. Jack, recently you guys announced Atlas, a $130 million liquid fund. Congrats. Could you share a bit of like the key insights or through the fundraising process and how the requests from LPs have evolved compared to the last cycle?
Sure. Thanks for having me. So my name is Jack Platts. I started Hypersphere in 2020. It's a digital asset manager. Prior to that, I joined the founding team of Polkadot in early 2018. So Hypersphere Atlas is, as you mentioned, it's a multi-manager fund. And it brings together a lot of the learnings from our previous funds. So how LP interest has changed over the past 4 years since we launched Hypersphere is LPs are more discerning. So in 2021, 2020, money was kind of falling from heaven like manna in the sense that you could raise a fund and raise capital rather quickly. And LPs have gotten a lot more discerning sense. So we've built our latest fund, our fourth fund, Hypersphere Atlas, around that. So it's a multi-manager, multi-asset fund. So what that means is we have 5 portfolio managers with diversified strategies. And we've evolved Hypersphere to focus on risk management. We've hired a chief risk officer, built processes and procedures around compliance and real-time risk management to be able to make sure we limit drawdowns, limit concentration limits, exchange limits, and so forth. And the real, I guess, risk with a lot of crypto funds in the past is LPs invested maybe in 2021 and wrote it up, and in some cases were locked up but paid carry on what they invested. And then when the market came down and they couldn't redeem, you had a situation where the net asset value or the value of their investment was sometimes lower than the fees they paid. So this is why we designed Hypersphere Atlas to really focus on the risk management piece.
Yeah, it seems that the multi-management structure has been a bit of a change from last cycle to this one, right? A lot of the fund of funds are moving towards that direction. Paola, you guys have a lot of experience in that. You've been a multi-manager since pretty much the beginning. Besides that, you have diversified further into also Bitcoin and ETH funds. What's the interest in those specifically? Are you noticing a lot more interest in Bitcoin ETH funds compared to like the other structures you guys have?
Yeah, that's a great question. To be clear, Hyla Funds is we've been managing hedge fund of funds for over 6 years. And you said, right, we're a multi-manager, multi-strategy platform. Our legacy fund is what we call a liquid venture hedge fund of funds. And a few years back, we wanted to expand our offerings, and we put together a joint venture with Amphibian Capital to launch 3 quant hedge fund of funds, 2 of them being crypto-denominated, one Bitcoin, the other one Ethereum. There are 3 main reasons why we decided to launch this strategy. The first one is that we knew that the approval of the ETFs was coming. And we understood that that was going to be the gateway for institutional investors to participate in the digital asset space. The second one was the last Bitcoin halving that just happened. We observed that a lot of the Bitcoin miners were interested in expanding their businesses beyond just mining Bitcoin. And we're seeing lately they've been investing much more in the building the infrastructure or developing the infrastructure of layer 2 on Bitcoin. And the third one, which is the most relevant to us, at least short term, is the long-term Bitcoin and Ethereum holders. We love the crypto whales. They're the investors, they make a lot of capital in the very early days. They've been holding their Bitcoin and Ethereum, but now what they're observing is like, wait, I have all this capital in a cold wallet, which is not necessarily the safest way anyway. We want to create a yield or return on top of what we already have. So that's why we launched these strategies. Now, I know there's a big concern out there in terms of exchanges in custody. We all had, to digest what happened in 2022 with FTX. The good news is that our incredible partner from Amphibian Capital, James Hodges, has been working very hard, creating very strong strategies and partnerships with banks like Sigmund Bank in Switzerland to figure out a way to separate custody from exchanges. So that's coming up. Amphibian will announce that, in the fourth quarter of this year, but we're working on that, so we're very excited about that.
I can second that. James is great. Kelvin, question for you. So Spartan is one of the largest or best-known funds in Asia. From an Asia perspective, do you share the same observations as Jack and Paola, or are there any particular differences between Asia and US that you see?
Yeah, sure. So we started investing in the space in 2017 and launched our first fund actually in 2018 with less than $10 million in capital. Obviously, during the bear market, it's typically very difficult to raise capital. And 2018, the ecosystem was much younger than what it is today. So currently, we manage about close to $500 million in capital, spread across 3 funds. So we have a liquid long-short hedge fund, which follows a fundamental strategy. And then we do have 2 venture funds as well that were raised in 2021 and 2022, respectively. So in terms of our LP base, I would say about half of it is institutional and half of it is high net worth individuals. And obviously a predominant number of them are based in Asia. We have deliberately, as part of our strategy, generally avoided US capital for various regulatory reasons, although we do have US-based investors in our fund if they reach out directly. And in terms of, I think, the way that these investors are different is, in general, I think Asian investors tend to be willing to accept the risk, with crypto investments in a way that some of these larger institutional pools of capital, whether you talk about endowment funds or pension funds, are less willing to. And also, in Asia, we tend to have a lot of family office money as well. And quite a bit of that is obviously in places like China, for instance, or even Korea, Singapore, and Hong Kong. And so with these family offices, many of these entrepreneurs made their money by taking risk, right? And so they are comfortable with the kind of risk that is involved with crypto investments, whereas a big institutional money manager that's managing external capital may require strategies that are perhaps lower volatility. So I think that's probably the most significant difference. But for us, when we invest, we look at projects from all over the world. And I would say that in the early days, many of the better projects tend to come out of the US and to a certain extent Europe. Over the last few years, we've started to see a lot more of those projects come out of Asia, right? So the ecosystem here is growing very rapidly, and I think particularly when it comes to at the application layer, we also tend to see a lot more projects here. So we invest globally, but we also do spend quite a bit of time here and have most of our team based here.
Speaking of geographies, actually, we were discussing before the panel a little bit about LATAM. Paola, is there anything you would like to add there?
It's very interesting how different jurisdictions and markets have different appetites. I always said, that these emerging technologies like blockchain and also AI will get implemented more efficient and faster in economies where they're needed. We like it or not, in the US, things work and the infrastructure works in a way. But in countries like in Mexico, I'm from Mexico City originally, we observe that there's a real need for these technologies to come in. And we've seen over and over again with some of the political, volatility, and instability, like countries like Venezuela. So there's a huge opportunity for us. We observe this fractionalized market, but also there's a lot of wealth in the region. We are about to launch next year at our first direct venture strategy for Latin America. And visiting Asia in a way, it's a good indicator of the appetite for Asian investors to come into this region because they understand the need. And more than ever with a commercial relationship between the US and China, we see all this injection of capital coming from China to Mexico and other countries in Latin America. So there's a huge opportunity there.
Jack, just a little bit more to what Kelvin was saying on where most of their venture investments are going. From your perspective, in 2020, where were you geographically, where were you investing more, and where are you investing more today?
Predominantly, we've been investing in North America, Europe, and Asia.
Is still the same today, you'd say, or has there been a little bit of a difference in some spots?
No, I'd say it's broadly consistent. Yeah, I'd say the best places probably to do venture capital continue to be San Francisco, New York, and London.
Mm-hmm. And this year, I think there's been a lot of chatter on Twitter specifically about why VC still are getting a lot more attention than liquid, and we still see that there's a dominance as like the capital that goes into VC over liquid. Why do you think that is? And this is a question that we'd love to hear from the three of you.
I believe that we're still in a speculative growth phase of the space. And we saw similar, activity in the early days of the internet, in the 60s, 70s, and then later in the 90s, where a big injection of capital was done by venture capitalists. And then these projects were struggling to show real returns, even though the valuations were only on paper. So we're seeing something similar. I think we're still struggling to see or find the real value of some of these innovative solutions, and we'll see, but we need to be careful. I mean, I remember 2017, during the ICO craze, the amount of capital that was coming into projects that make no sense whatsoever. And now, after what happened in 2022, we are being more cautious about where we invest our money. And I will say this, for all the managers out there, the hybrid liquid venture fund strategy is very attractive, but we also need to be very careful not to push our founders to launch a token what is not necessary. We really need to look at the application. Not all the application need a token. We want the liquidity, yes, and we want the high returns. But with those high returns come high risk attached to it. So it's the double-edged sword. So I think we do have the responsibility as fund managers, to be careful about that.
I'm glad you brought that up. I think some people in the audience will also agree with you. Jack, Kelvin, anything you want to add to that?
Yeah, I had a couple of things because we manage both liquid strategy as well as two venture funds, right? So we actually talk to investors that sometimes are invested across all three funds, but sometimes prefer the liquid strategy or the venture strategy. All right, I would say a big challenge for most investors that are investing in the liquid strategy is the volatility of the fund, right? So there's some months where we could be up 30%, there's some months where it could be down 15, 20%, and a lot of family offices as well as institutional investors have trouble with that kind of extreme volatility, right? And they can't sleep at night, right? So that strategy is not for everybody, but at the same time, I can also tell you that if you look at the last cycle between 2020 and 2021, those 2 years, our liquid fund delivered 15x return. There's no crypto venture fund in the world that even over a 5, 7, 10-year lifespan will be able to do that in such a short period of time, right? So if you are able to manage your liquidity, then the liquid strategy makes sense and you can withstand volatility, right? Not everyone can. Whereas on the venture side, I would say that I think a lot of investors, including family offices, they don't see the volatility when they invest in a venture fund, right? Because the capital gets deployed over a number of years and the value from these projects gradually accrue. Mm-hmm. So, and they don't have to make any decisions about when to invest and when to redeem. The capital gets returned to them at the end of the fund life, right? And if you've invested in a good fund manager, then ideally you should get a few X on your investment, right? And some of these investors also are trying to learn more about the Web3 space, and they also eventually want to be able to build up their own capability to deploy into these projects. So many of them invest in these venture funds to also get direct deal access and hopefully increase their own capability over time, right? So the strategies are quite different, but I would say there is a point in the cycle where the liquid strategy is very interesting, which is now, whereas there's a point in the cycle where the venture strategy is more interesting, right?
Yeah, and I'd add that the launching a crypto fund is harder than it was in terms of the competition, especially on the venture side. There is, because of the returns, you guys had amazing returns, 15x. We've returned 650 million profits in 4 years. And so whenever you see funds sending around decks that say, hey, 40x, 15x, 50x, that brings in a lot more competition. Other fund managers see that and go, well, maybe I should have a crypto arm, or maybe I should start a crypto fund. So that brings in a lot more capital. That increases the valuations for projects raising and ultimately dampens returns. So whenever we think about venture fund, I think you have to be aware that you need to have a competitive edge. And so we've taken a lot of the carry and profits to invest in systems and people and to build that competitive edge.
So this is all fantastic information, but now I'm wondering, what will be the future of funds the next 1 to 5 years, right? Like hybrid funds is kind of a new thing of this cycle as a proxy of what happened the last cycle. Will regulation play a role in the definition of crypto funds specifically?
I definitely think regulation is a key component for the ecosystem. I mean, we're seeing, especially in jurisdictions like the US. As I said before, I think the heavy capital allocation is still going to traditional venture funds and not crypto. There's a huge difference in that. But also, as I said before, I think it's important that we start making a norm, splitting, for example, exchanges from custody. I think we're starting to see more negotiations and partnerships with traditional institutions to make that happen. But I think until we don't accomplish that, it's still going to be difficult both to raise capital for crypto funds, but also to deploy in projects that are actually innovative and based on fundamentals and not a speculation.
I think regulations are good in the long term because it brings more capital into the space. I think on the venture side, it probably won't affect venture funds so much. I think venture funds will probably sort of see more competition, but it's not because of regulations, but because of the pool of capital that wants to be in the space. I think on the liquid side, over time, the regulations will matter, and fund managers that are regulated will have an advantage over those that aren't. But getting that timing right is really important because we have observed many funds that chose to be regulated 2-3 years ago, and frankly, they've not really benefited from that at all. Just because the regulations don't give investors safe harbor protections, right? Because the assets are not regulated across the world at the moment. But what we've seen recently also is, even with the introduction of the Bitcoin and Ethereum ETFs, that alone has sort of shifted the conversation, right? Where before, investors were happy to look at absolute returns from our strategy, for instance, and now every month they're looking at the performance of Bitcoin and ETH and comparing our performance with that. So they've become more sophisticated, and they also don't want us to hold any of the larger assets because they can invest themselves. They don't have to pay us a fee to do it, right? So the game's definitely gotten more competitive. And then the other trend that I think is going to be very important with regulations is that when it happens, and all of the large traditional asset managers, the T. Rowe Price and Fidelities and Capitals of the world, that capital can then come into the space, right? And we start to see the creation of long-only funds, crypto funds, right? Which today doesn't exist, right? In crypto, a lot of investors are very short-term minded. There's no long-only funds, right, the real diamond hands, and that's why the asset class faces so much volatility. Whereas if you have that investor base, which typically is many times larger than hedge fund capital, then hopefully that will dampen the volatility of the asset class in the long term.
Yeah, unfortunately, we are at time already, but this was a great panel. Thank you to the three of you for answering all these questions. And yeah, just as a final thought for everyone, we've touched on, like, I was reading it this morning, we touched on like the number of funds that were there in 2018 as opposed to today. In 2018, there were 50 funds that were crypto native. Today, there's 1,150. So I think we've done something pretty good, and hopefully next year there'll be 1,500. Thank you very much, everyone.
Thank you.